We heard quite a bit from members of the Bank of Canada this week, and we're going to be diving deeper in this video. Why are they so adamant on the target inflation number of 2%? We're also going to be discussing what they see for 2023 in terms of CPI projections. And more importantly, we're going to be going through into the markets to see what the markets are pricing in for this year. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Before we hop into the video, a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And we drop a video every single Sunday, so make sure to come back to the channel and check it out. So we'll start by going through what Paul Beaudry said at the University of Alberta, saying that the bank is fully committed to returning inflation to the 2% target. For 3 decades, this target has served Canadians well. It represents a sweet spot for inflation and remains the centerpiece of the bank's inflation targeting framework. Keeping inflation stable and predictable at that low level is the best contribution monetary policy can make. Paul went on to note, the longer inflation stays significantly above target, the greater the risk that these mechanisms could turn from stabilizers into destabilizers. And when he talks about why it's so important to stick to that 2% inflation number, he mentions that as Canadians know too well, high and volatile inflation makes it difficult for everybody to plan how to spend and invest. For example, companies could find it more difficult to make key decisions for growing their business when they don't feel confident about what their costs are. So it becomes very hard for a business to go and take out a loan, especially if they don't know what the economic future holds. But the negative effects don't stop there. Increased volatility in inflation can also be costly because it scrambles the signals from prices and makes it hard to judge whether a higher price represents a true change or something else. This makes it difficult for firms and investors to allocate their resources to their best uses, and it can also impact consumer behaviors that make the economy less efficient. I'm sure we're all feeling this independently, whether it's the cost of goods going up or whether it's your mortgage rate going higher. This needs to be addressed by the Bank of Canada, not only for individual citizens, but also for businesses as well. With higher rates, it's harder for them to pull out loans, and it's something that can't go on forever, and they would rather focus on driving the inflation down, although we have started to see that number cool off. Now we'll take a look at what Tiff Macklem said this week in regards to the economic outlook. We know it takes time for higher interest rates to work through the economy to slow demand and reduce inflation. That's why their policy needed to be forward-looking. And that's guided what they've seen so far in terms of the outlook for economic growth and inflation. And we did start to see that CPI number come down, and that's why they have decided to pause interest rate hikes in the interim. But the goal still remains that they're going to return inflation to the 2% target. It's important to note that the developments are in line with their expectations, and if inflation continues to come down from here, then rates won't need to go higher. But if evidence begins to accumulate to show that inflation is not declining, then they are prepared to raise interest rates further. Now, this is the biggest question right now that the markets are trying to price in. Is inflation done and over with, or could we see something that's happened similarly in the 70s and 80s where we had multiple peaks of inflation? I think that's the biggest question right now, especially when you look at our latest jobs report when we were able to add over 100,000 jobs. Additionally, GDP doesn't look so bad for Q4 of last year, but these numbers are still yet to be confirmed. But what does this mean for the long-term outlook? What does this mean for 2023's outlook? We expect CPI inflation to fall to around 3% in the middle of this year and reach the 2% target target in 2024. In my opinion, it's hard to see CPI falling to 3% this year, especially when we look at so many costs that remain high, whether it's groceries, oil is still trading relatively high. There's so many things that are still eating away. Although those aren't increasing in price, the inflation is becoming sticky. It is still around. We're not seeing any deflation, meaning prices going down. So it's hard to see that they'll hit this target, which gets me a little bit skeptical of what the Bank of Canada is saying. They do go on to note the risks. Global energy prices could jump again, pushing gas higher, oil higher. This is not only in driving your car, but also the production of goods. And it's still something to be watched and considered, especially when we have so many upside risks right now in the world. So we know that Tiff Macklem has issued a pause in its interest rate hikes, but we're going to dive a little bit deeper to see what the market is pricing in. Now, I know this is just speculation and there's a variance of risk that comes in here, but what we can read is that despite the guidance, the market still sees a strong chance of one more hike later this year. Our take is that market is pricing in almost a 50% chance of an additional 50 basis point move in the hikes this year. That's 50%, which is relatively high. BMO goes on to note that their view continues to be that the bank is most likely to stay on hold for the rest of the year with some upside risk. Although it is priced out in futures, we'll take a little bit of a deeper look at what the bonds are pricing in. So we can see here on this chart that the bond is pricing in about 3.4 on the Canadian 5-year bond, which is how they price the 5-year fixed mortgage rate. If you haven't seen that, I'll link a video up above. But then what we see is in the later months, September, December, and March of next year, this 5-year rate moving higher. What does that mean? That means that the 5-year fixed mortgage is going to be moving higher, and that's most likely because the market sees potential rate hikes. They see inflation as being sticky, and it may be persistent and around for a little bit longer. So based on this, obviously there's a lot of unknowns. There's unknowns as to what CPI is going to do. There's unknowns as to what GDP is going to do and jobs, etc. But if the economy continues to push on stronger, the likelihood of them increasing the interest rate definitely increases. It's definitely something that we've seen in the past. When inflation spikes, when inflation goes higher, the bank interest rate needs to move equivalent, if not higher, in order to bring it down. So these next couple months are going to be something to watch out for. I am in the camp that we are not going to see the rates move down. If anything, we could definitely see the bank moving higher on their interest rates. So take that into whatever your perspective is. Let me know down below what your thoughts are. But right now, there's still so much risk, especially when we're in the economic cycle of tightening. We're making money more expensive to get, and therefore businesses are finding it harder to invest, and people should eventually find it harder to spend, although the numbers haven't shown that yet. So obviously, if you're still here with me, hit that like button. I appreciate your support. I hope you all have a great week in the markets. Happy trading.